Welcome back to The Frontier. I'm your co-host, along with our host, James Rockwood, and we've got Ben Creary, National Sales Manager from Vanguard Canada. Thanks for being here, Ben.
Thanks for having me.
Can you tell us a little bit about yourself?
Yeah, thanks. Well, thanks again for having me. Really looking forward to the conversation. National Sales Manager. I manage the field sales team at Vanguard Canada, and I've been here for about 12 years. Started on the inside desk. Within about a year and a half, I was asked to relocate to Montreal. So I was the sales executive in Montreal for 5 years, working with financial advisors across the province and also Eastern Canada. And then about 6 years ago, relocated back to Toronto to take the key accounts role. So I managed a lot of the head office relationships for Vanguard. And in December of 2019, moved into this role. And I'm very fortunate to work with a great team of sales professionals across the country. And part of the best part of my job is really the opportunity to spend time on the road and spend time with our advisor clients across the country.
That's awesome. And you're a cyclist, we were talking about it?
I am a cyclist, I am, yeah.
Nice. Any miles in today?
Not today, a quick Peloton ride, but feeling good.
That's good, it's more than I've done. So I think everybody knows about Vanguard and knows the brand. It's such a strong brand, but I don't know if everybody knows the story. Can you tell us a little bit about Vanguard and maybe a little bit of background about them?
Sure. So Vanguard was founded in 1975 by Jack Bogle. I'm sure many of our listeners are familiar with Jack Bogle, but for those who are not familiar, he was in the view that in order to be a true fiduciary to clients, and a mutual fund company should be structured as a mutual. And that's really what drives Vanguard, what makes us tick. We are owned by our unit holders, which is quite different from most companies out there. And it's also part of our competitive advantage. So we operate at cost in the US. So it's the funds, the US mutual funds and ETFs that own Vanguard, the company. And we here in Canada and the other international businesses are a subsidiary of Vanguard in the US. So though we're not technically structured like we are in the US, we do operate under the same philosophy. And the benefit to investors is that, well, one, we keep things simple. We're not trying to be everything to everyone. But as our assets grow and as we leverage our $7 trillion, we give back our profits in the form of lower fees. So if you look at Vanguard back in 1975, our average expense ratio was about 68 basis points, so 0.68%. And now we're at 0.09, so 9 basis points. So we've saved investors across the globe millions of dollars in fees, maybe billions, and that's our philosophy, and that's what makes us tick.
That's cool. And it sounds like over the years you've come up with your own investment philosophy, the 4 principles of successful investing. What do those entail?
Yeah, so those are really enduring principles that reflect the past, but also the future, and what helps us, what guides us in helping our clients make really strong investment decisions. And those are based on 4 pillars, which is goals, balance, costs, and discipline. So goals, we all have constraints as investors, whether we're saving for retirement, whether we're saving for education. We have a specific time horizon in mind. So it's important to understand what those are, because that is going to drive our investment philosophy. And the other constraint is our tolerance for risk. We've certainly seen in the last couple of years a lot of volatility in the markets. So if we're taking on too much risk and we're not going to be able to tolerate that, well, that will hurt our long-term objectives and what we're trying to accomplish in our investments. So number 1, goals is incredibly important. Number 2 is balance, and balance across different asset classes, across different geographical allocations, making sure that when we build portfolios, whether you work with a financial advisor or you do it on your own, that you take that into account, that you have a properly well-balanced portfolio, because that will help you achieve your long-term goals and also stomach some of that volatility that we've certainly seen recently. The next one is cost. We can't control performance, unfortunately, as much as we would like to, but cost is certainly something that we can control. And if we invest in funds that charge too high of a fee, that is a huge obstacle in terms of achieving our long-term investment goals. So, obviously, Vanguard, we are well positioned, given that we do operate at cost and we operate with that same philosophy in Canada to provide those low-cost building blocks to investors. And then finally, the last is having discipline. being able to have that long-term perspective, stay invested, not make poor, rash decisions. The more we try to guess what the market's going to do, ultimately those outcomes could be quite negative. So, whether you do that on your own or working with a financial advisor, and we can talk about that as well. But that's where an investment advisor can add a huge amount of value in terms of being that behavioral coach that can help investors maintain that long-term discipline.
And you mentioned that one of your favorite things to do is get out in the field and talk to advisors. Have those 4 principles kind of resonated equally over the past few years, or recently have you seen some of those principles like you're talking more about or advisors are asking you more about?
Yeah, certainly. I mean, if we look at across the globe, the tendency is really for advisors and investors to shift towards lower cost investments.
Yeah.
And that's, a key pillar amongst our 4 pillars. So certainly we're seeing advisors really adopt that philosophy in terms of how they build portfolios and how they think about portfolios. And we, there's a term coined, the Vanguard Effect. So whenever Vanguard comes to a market, whether it's before or immediately after, in the asset classes where we compete, we often see competitors either match or beat us on fees, which we ultimately think is of great benefit to everybody, to all investors. So we're certainly proud of that. And in terms of what we're seeing, Vanguard coined what's called Advisors Alpha about 20 years ago. And that was really to help advisors articulate their value proposition to things other than purely based on performance. As I mentioned, we can't control performance. So Advisors Alpha was really about kind of broadening that lens of how we should evaluate financial advice and financial advisors. And we're certainly seeing advisors shift to more of a holistic wealth management aspect, uncovering goals, having an investment policy statement, providing that balance, providing really well-structured portfolios, leveraging technology, leveraging asset allocation type of ETFs and those types of products to really help execute on those 4 pillars. And what we found is as we've evolved the Advisors Alpha framework, we also tried to quantify the value that an advisor can bring to the table. And what we found, and we've done this in many different markets, the UK, the US, Australia, Canada, what we find is that advisors have the possibility or the ability to potentially add 3% of returns after tax to client portfolios. And half of that we attribute to behavioral coaching. So the most important role that an advisor plays, not only establishing those goals, providing that balance, using low-cost building blocks, but that behavioral coaching element is really important.
Yeah, I think it's interesting too, because one of the things that you said, you can't guarantee performance, you can guarantee cost, you can guarantee service as well. And I think experience around investing is so critical and a huge component of what advisors can bring to bear. I have 2 questions. The first is, are you seeing that the alpha is changing? Is there more opportunity now because there's a better opportunity for advisors to have broader, more holistic conversations? Because I think a component of it is they now have much more technology to have bigger and broader discussions with their customers. I'm curious if that advisor alpha over time is sloping up at all, or if it's becoming better. I'll let you answer that first. But have you seen anything in that in the data you've looked at?
So that's certainly something we're revisiting, the Advisors Alpha, and in Canada we'll be kind of re-releasing an updated package of collateral that we can share with advisors. But it's still within that 3% range, so we haven't seen that increase dramatically. Like in any career, I think moving forward, leveraging technology and the impact that technology will have on the day-to-day for an advisor, it's really important to anchor our value proposition on those uniquely human elements. Providing consensus, providing that vision of what the investor's goals are, and harnessing the power of technology or products that mimic what a digital advice platform would make, like an asset allocation ETF, for example, helps the advisor not only immunize themselves to digital advice, but also compete on it, because you're actually providing something that is uniquely human, and money is emotional. And so oftentimes advisors joke that sometimes they play the role of psychologist, and particularly when you go through times like COVID-19 and really stressful equity markets.
Ben, you mentioned that advisors can help with investor behavior. Do you mind talking about the most impactful areas that they can help and sort of the typical investor behaviors that they can counteract?
Sure. The most detrimental investor behavior that we see is the buy high, sell low. If you think back to the global financial crisis in 2008, if you were working with an advisor and they were able to, quote unquote, talk you off the ledge and keep you invested, that added a tremendous amount of value because we did see a lot of investors go to cash at the bottom of the market, let's say at minus 40, and then they didn't get back in until 2011. And just the amount of return they gave up by making that decision impacted their investment portfolios for a long time. That will make that reaching your investment objective that much harder. So the buy high, sell low, that is a very common investor behavior. So working with an investment advisor that can help coach you to not do that, that is where you will add the most impact as an advisor.
Yeah, I think it's important to note now too, and it falls into one of the four principles of investing, that because advisors can track your goals and model out potential scenarios with financial plans, they're really well equipped to give you a reason of why you should stay in versus, relative to your goal. Like if you can still achieve your goal and it feels like the world's falling apart, but your goals can maintain intact in the majority of situations, then staying with it and riding it out versus just selling for the sake of selling and selling for the sake of fear, I think is a really important component. And so that's something that's I think's happened in the last sort of 4 or 5 years. The advice market has just started to pick up a lot of financial planning that's going to allow them to say, here's why you should stay in, because your goals are still intact or they'll likely be intact based on whatever outcomes they want to model. So I think that's cool, and it ties back into the four principles earlier.
No, absolutely, and it's important for advisors to kind of reestablish or reaffirm the goals that have been set out, and by asking questions: have your goals changed? Has your time horizon changed? Because and then you can actually show investors where they are on that journey. It's not a linear journey, but at least if they can show that you're going to make progress, you're on track to do that. So my recommendation would not to be change anything. I think that's a powerful message and an important one.
So, kind of getting back into spending time in the field, when you're talking to advisors, how do you help them articulate the value of Vanguard, and how do you really fit into what they're doing with their clients?
Yeah, I mean, ultimately, what we want to be is great partners
Right.
with our clients. We have the advantage of having a global scale and a global presence, and we work with advisors across the US, across Canada, across the UK, Europe, Australia. So we're able to provide insights into what we're seeing in other markets
Mhm.
to help advisors understand where they are as it relates to advisors in different geographies and different areas of the globe. So a few years ago, we also launched what's called the Portfolio Consulting Service.
Okay.
So that is a service that came out of our institutional group in the US, and we had a lot of success with it. So in the US, we launched it to the advisor channel, and we decided to bring that to Canada. And what it is, it's an institutional quality deep dive into portfolios to help advisors understand if they have any intended or unintended gaps or drifts within their portfolios to ultimately help them make better investment decisions for their clients. So we'll look at style drift, we'll look at geographical allocations, stock overlaps, and particularly what we saw throughout into the pandemic. Actually, over the last 10 years, it's been more of a growth market.
Okay.
And last year, we saw a reversion to being more of a value market. There's a big sell-off in growth stocks, but value stocks perform quite well. And what we've found, particularly over the last couple of years, is that whether intended or unintended, advisor portfolios had drifted more to the growth side of things, and there was an underweight to value stocks. So this service helps advisors identify that and then they can work with our sales team to see if maybe a Vanguard solution would be appropriate or not. But we really try to provide that third-party kind of observational look at portfolios to really help advisors make better investment decisions. The other component would be practice management. So advisors alpha, the value of advice, quantifying that value. The last iteration of advisors alpha was also the impact on technology to the advice business and how advisors should think about harnessing technology to compete in that type of competitive environment. And we've also launched what's called the family legacy planning. Advisors have access to will and estate specialists, insurance specialists, et cetera. They provide that holistic wealth management. Family legacy planning is really bridging that gap between the planning and the communication. Oftentimes, what we found is that typically wealth is squandered in that third generation, and it's not due to a lack of planning, it's due to a lack of communication. The next generation, those that are going to inherit potentially a significant amount of wealth, are not prepared to do that. And having that communication and having the advisor being that bridge to help different generations of wealthy families being able to be prepared. What is the money intended for? Do we have a family mission statement? Things like that. So those are other resources that we're providing to advisors. And that's really in the hopes of being viewed as partners. We want to partner with advisors. We don't want the relationship with our clients to be transactional. We want to be partners and help them make the best decisions for their their end clients.
Yeah, I think that makes an interesting parallel. What we mentioned earlier with advisors being able to guarantee service, but asset managers also being able to guarantee service to the advisors and helping them, especially in some of the more holistic discussions. I want to double click on a comment you had earlier around how you saw that a lot of portfolios had shifted to a more of a growth heavy portfolio. What else have you seen as far as trends in portfolios that have happened, especially in the last few years with the increased amount of market turmoil?
Yeah, certainly. I mean, one thing we were hearing is that the 60-40 is dead. It's worked for 100 years, so I don't know that I would put my money on the fact that it'll be dead for the next 100 years. So we don't necessarily agree with that. And in fact, with rates kind of having shot up significantly, bond returns look very attractive moving forward. Yield to maturities on high quality bonds are now, if you look at the Canadian Aggregate Bond Index, you're over 4%. High quality corporates, you're over 5%. So bond yield to maturities are now quite attractive. And last year, certainly we saw a repricing based on unanticipated risks, and both the equity and bond markets corrected, which for balanced investors last year was definitely a headwind. But it was in terms of bond returns, it was the worst period in 100 years for bonds. So we certainly think looking forward, the 60-40 is probably more attractive than it's ever been, or been in a significant amount of time. We think that a balanced portfolio, a globally diversified portfolio, the returns are anywhere around the 6% range, but it used to be 3 to 4%. So the prospects of a 60 portfolio has definitely improved. In the past, particularly with COVID-19 and the pandemic, we saw a lot of stimulus, basically zero interest rates. So bond returns were not attractive. So we certainly saw a lot of proliferation in the alts portion of the market. So we don't necessarily think there's anything wrong with that. It's just typically that comes at a higher cost. Mm-hmm. And the dispersion of returns between different strategies, because alt means a lot of things. So manager selection is even more important in that space than in your traditional active mutual fund space. So certainly that's a trend that I think a word of caution to investors and advisors: really understand what you're buying and make sure that it's at a cost, at a level of cost that's not prohibitive in terms of providing those future returns. And because the 60-40 does look quite attractive right now, given where rates are.
Has Vanguard tended to trend away from alts, or do you see kind of the next frontier being able to help go, correct costs or go help with the Vanguard effect in that area? Yeah,
I mean, candidly, we do have a private equity mandate in the U.S. with HarborVest. However, that the minimums are quite high. It's more for institutional investors. Providing alts that we think of when we think about institutional investors to the masses, that's quite challenging. So certainly not an easy thing to do, but we're always looking at, what can we do better than our competitors at a lower cost? And if we feel we can provide access to that market, in a better way at a lower cost, then we'll certainly explore that.
Yeah, it's so nascent right now. It's really interesting to see how people are trying to help retail investors get access to it. And so I'm sure when Vanguard shows up, if they choose to go with an approach, it's going to be a pretty fundamental shift in access to it. So we'll be watching that. And then do you think too so you're saying 60/40 is here to stay? Does that mean, yes, so long as interest rates don't go back down to zero? Or is it yes, like we just think, given the long-term history of the benefit of it? I'd just love to get your take on that, because I feel like for interest rates, everybody's kind of, okay, this is cool for a little bit, but like we're going to go back down to zero, right? Certainly if variable mortgage holders are thinking that.
Come on.
I'd love to get your comment on that.
Yeah, I mean, we don't think they're going to go back down to zero. If we look at our market and economic outlook, we think in the U.S. at least that rates will start coming back down probably in the second quarter of 2024. But we don't think they're going to go back down to zero. But we also don't think they're going to stay where they are. So certainly, I mean, when you think about a 60/40, I'll take it back to the four pillars: balance. Typically, I know if you look over the long term, bonds and equities are negatively correlated. When the stock market corrects, bonds typically do well. And as we will see eventually, rates come back down, you will get that price appreciation on your fixed income. So that will ultimately benefit bondholders as well as rates kind of normalize. But certainly, I mean, in terms of that diversification element, that balance element, back to that second pillar, that's where we see the 60/40. And that's why we think it's going to be an enduring investment strategy moving forward. But again, that's why it's important to understand your goals and your objectives. If you have a longer time horizon, then you would have less fixed income or bonds in your portfolio. And if it's a shorter time horizon, well, that would probably reverse. So understanding your goals, but maintaining that balance, because there is that negative correlation and that ballast to your equity risk. We certainly think it's an enduring investment principle.
That's awesome. On the speaking about balance, I think part of what we like to cover on the frontier, brand new funds, also marquee funds hitting milestones. The Vanguard has asset allocation ETFs that recently hit the 5-year mark. So congrats.
Thank you.
On that. And I'd love to just chat a little bit about those and how they differ from traditional ETFs, so asset allocation ETF versus a traditional ETF. And then how you think it helps with diversification, the sort of 60/40 discussion we've been having.
Yeah, so the asset allocation ETF, the biggest difference from kind of the ETFs that maybe everybody's thinking about is it's a multi-asset strategy, meaning it embeds both an allocation to equity markets on a global scale, but also on the fixed income side on a global scale. So think of your kind of traditional balance fund. Obviously, we have different equity and fixed income allocations depending on your risk profile. But that's the ultimate difference, that it's a multi-asset portfolio, 22 basis point, globally diversified. So you could think of it as a one-ticket solution as opposed to building your own stock and bond portfolio using individual building block ETFs. So that's the biggest difference.
And then we think about 5-year milestone. We know it's big to hit. Can you explain a little bit why it's a big milestone to hit?
So certainly a big milestone because it's another proof point that these are really effective investment strategies. We're a global leader in multi-asset strategies, so it's just if you look at kind of industry standard, 3, 5, and 10 years are kind of the benchmarks that people typically evaluate investment solutions by. And they've done really well. They've performed well. They're globally diversified. They're strong investment building blocks that is really appropriate for any investor. Whether you're a DIY investor and you want a one-ticket solution to kind of put in money on a regular basis, or if you're an advisor looking for a small account solution, or even as a complement to what you're doing, maybe on an individual securities or active mutual fund space, that's a great tool to get your, what the market's going to give you on a global scale at a low cost. That's a really effective trading tool.
So I'll kind of go back to where I like to be as well in the field, talking to customers, hearing what people are saying. And I think what's probably really compelling is the combination of innovation that Vanguard brings, but also the tradition. And so, how do you think about, responding to customers, what customers are saying, what the research is showing, and kind of fitting those two things together?
Yeah. I'll bring it back first to the asset allocation ETFs.
Sure.
Those were very innovative for the Canadian marketplace. There were existing products already here when we
Yep.
launched our asset allocation ETFs 5 years ago now, but they were quite expensive. They hadn't attracted much by the way by assets, and we were able to create the market there. We've attracted almost 10 billion in flows over the last 5 years, so they've been extremely successful. Providing globally diversified portfolio at 22 basis points. I mean, that was really innovative for Vanguard here. The other side where we're seeing innovation is on the digital advice.
Okay.
So that's certainly where we're seeing a lot of innovation, not only in Canada, but in the US and in the UK and Australia. And we actually did some market research with people who work with a human advisor and those that work with a digital advisor. And what we found is that 88% of those that are on digital advice platforms are actually open to working with a human advisor, as long as there's a combination of technology and that human interaction in terms of being that sounding board, providing that advice, those opinions, and really that behavioral coaching element that digital advice platforms can't necessarily bring. So that kind of combination of digital advice and human interaction is something that's very appealing to investors, and certainly where we're seeing a lot of innovation.
Yeah, I think it's interesting because when you looked at the initial sort of surge of robo advice and the promise to provide it and the fervor around it, it never really hit where people thought it was going to go. You can even look at studies from as recently as 2016 about where robo advice should be from an asset allocation or a AUM perspective at this moment, and it's a far flung from those kind of initial forecasts. So it's interesting to hear that there's a large appetite, even with people who are now using these more mature products, these more mature robo type solutions or digital advice type solutions, that are still interested in shifting back. Because I agree, it's something that is emotional, and I think that the improvement in service between even 2016 and now for advisors, and the discussions around more holistic discussions, getting to know you beyond just sort of transactional relationship and talking about financial plans and helping with behavior, are all some of these, and tying it back to goals, are all some of these really important things that advisors can do. And I think the market is now starting to hear about it, and certainly DIY investors or digital advice customers are probably seeing that as an opportunity, because that's a really strong indication. Like 88% is a pretty material number. So especially if you can provide stuff at low cost and sort of compete with that whole component of it as well, I think it's like another big opportunity for advisors to continue to advocate and show, here's how we're different, here's the value we can add, here's the alpha we can add. So I think that's a super interesting stat. I just found it really fascinating. Kind of makes sense with a lot of the ways that we're looking at the market today. I think when we're considering, we covered a lot of ground today. When we're talking about what some of the key components that advisors should take away from this discussion, I'd love to kind of get your thoughts.
Yeah, I would say, in terms of, we always get asked, why Vanguard?
Yeah.
I think our corporate structure, the fact that, we're mutually owned in the US and we operate at cost, that has a direct benefit to advisors and investors. We're continuously driving costs down for our investors, and the Vanguard Effect has I think affected the Canadian industry, but also the global investment landscape in a very positive manner. We've saved investors billions of dollars. So I think, as you think about Vanguard, I think just understanding what makes us tick, I think, is really important. That's really central to who we are and why we do things. Number two is the four pillars, goals, balance, cost, discipline. They're very simple, but they're enduring principles representing both the past and the future of investment. And we really lean on those when we think about the products that we launch in the market and how we want to help our clients make better investment decisions. And then finally, our asset allocation ETFs, those were really innovative products in the Canadian marketplace. And they kind of mimic what a digital advice platform could do. So, in terms of harnessing technology, making your practice more scalable as an advisor, these asset allocation products are a really effective way to add some of that scalability and providing that global market exposure at a really low cost. It's rebalanced for you. We have 5 different target risk profiles. And when we think about what explains the variability of returns, it's really the strategic asset allocation mix that drives that. In Canada, it accounts for 86% of that variability. So that's the most important decision. And this is a one-ticket effective solution to help make that decision and anchor portfolios to that specific risk profile.
Ben, I really like that summary. I think you pulled together kind of everything really succinctly that we've covered today. So really appreciate that. Thank you so much for joining us today. We'll see you next time on The Frontier.